After 2 years of uncertainty, in 2024 private equity deal-making appears to have turned the corner. Liquidity constraints, tougher fundraising conditions and competitive deal-making remain important challenges, but clear signs of recovery have emerged. Global buyout deal value jumped by 37% to over $600 billion, marking the first annual increase since 2021. Of course, activity does remain below 21 and 22 highs as investors still navigate interest rate volatility, valuation mismatches, and slower exit markets. Exit activity rose by 34% to $470 billion, a sign that liquidity constraints may finally be easing. This was driven mostly by a surge in sponsor-to-sponsor transactions, though IPO markets did remain subdued. Distributions as a percent of net asset value fell to one of the lowest levels since the global financial crisis, reinforcing the need for alternative liquidity solutions. Meanwhile, private equity firms still hold a backlog of 29,000 unsold companies. Dry powder declined slightly, but we still have $1.2 trillion on the sidelines waiting to be deployed. Interestingly, $282 billion of this is aged to more than 4 years, which shows how much pressure there is to invest. Fundraising remained challenging, declining by 24% globally, with fund closures at half the pre-COVID levels. LPs stayed selective, favoring established funds with a clear edge. We also saw by mid-year investors recalibrating expectations, and we actually show the shift of focus to fundamental value creation on their companies over financial engineering. So deal-making is now centered on margin expansion, operational transformation, and platform building rather than multiple arbitrage. So now let's shift our focus to the Europe, Middle East, and Africa region, where the private equity industry mirrored global trends, with deal value up by 54% to $212 billion. This growth was mostly led by the UK, France, and the DACH regions. Larger transactions, particularly those in the 5 to 10 billion range, drove the rebound, pushing the average deal size to more than $800 million, which is the highest we've seen in recent years. We also saw buyout multiples hitting a record 12 times EBITDA, highlighting the intense competition that existed for high-quality assets. Also in Europe, exit markets gained momentum, growing 28% to $145 billion, with sponsor-to-sponsor transactions playing a major role for that. However, also in Europe, liquidity remains tight, which reinforces the need for alternative exit solutions. To bridge the gap, firms turn to minority stake sales, dividend recaps, and net asset value-based loans. Fundraising in Europe also declined by 2% to about $140 billion, with mega funds shrinking by 17% as LPs maintain a cautious stance. Now, predicting the future is tricky, but barring major disruptions, economic conditions suggest continued improvement. As capital starts flowing again, winners will be those with a differentiated strategy and a track record of consistent performance. Now, in this new phase, private equity firms must focus on 4 strategic priorities. First, generative AI. 1 in 5 private equity-backed companies have already operationalized AI, and leading firms are embedding it into investment processes, due diligence, and portfolio management. AI is no longer an experiment, it is a competitive necessity. Second, with multiple expansion no longer a given, firms must embed operational expertise into deal strategies. Revenue growth alone is not enough. Firms must convert growth into profitability by integrating commercial, technical, and operational intelligence from the diligence phase. Third, corporate carve-outs. While still outperforming the average buyout, carve-outs have become much more challenging. Firms must go now beyond just separating the company. Unlocking real value from day one requires a well-defined transformation strategy. And finally, the industry is maturing. Competition for deals, capital, and talent is intensifying. Private equity firms that define their sector specialization, operational differentiation, or geographic expansion strategy now will maintain the strongest competitive edge for the future. So looking ahead, 2025 will be a critical year in determining the sustainability of this recovery. Private equity is rebounding, but this cycle is different. Generating alpha has never been more challenging, and the cost of generating market-beating returns is rising. Opportunities are and will be emerging, but simply riding the recovery wave won't be enough. With LPs more discerning than ever, winners will be those firms with a clear value creation model, a strong execution strategy, and the ability to sustain long-term performance. The industry is evolving, and the firms that lead this next phase, not just react to it, will define private equity's future.